Yes, so today this is Anthony Mwangi. So today I want us to have a rich conversation about life. Yeah, you see, in this life, everybody, kila mtu we focus to have a long life. We believe that you are going to have a long life, and of course a successful one, right? So in as much as you are working towards attaining our goal, one of the main goal for us, and for many of us, those who are adults, is that you want to invest in the education of your children. Yeah, it said that that's the best investment that you can give to your child. When you give the child quality and good education, you are assured, right? Like in life, you will not suffer maybe, because when you have the skill or the technicality, he has the education, he or she is good to go. Yeah, right. So, and each one of us looks forward to giving their children a good school, a good life, a school whereby he'll be able to get everything according to what is in our mind. Most of the times, what is in our mind is that we want success, 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 and we want the best for our children and also for us. So, when you are pre-focusing for a good school for your child, are you saving towards that? Or are you waiting for that day when it comes, you'll start saying, God help me, I need school fees, or you're just blaming your ancestors that mambo ni mbaya. But it should be a journey that you should start long well when you are still energetic, because you are able to make simple and the small steps at a time, and be able to achieve the goal at the end of it. So there are places where you can save towards the education of your child. You can decide, either say that I do save in a bank, I do save in a circle, I do save in an insurance. Those are three different institutions, and all of them can give you what you need. When you save in a bank, uh, at the end of it all, the money is yours, you still get it. When you save in a circle, it's yours, you still get it. If you save in an insurance, it's yours, you still get it. But I want you now to know the difference between how those three institutions work. For example, right now, also another thing that I know we are always the only thing, or I think the one of the thing that we always have 100% probability that it's gonna happen is death. Death is 100% probability that it will happen at one time. You all hope to live a long life and believe that you're going to have a long life, but what if death comes closer than you may imagine? I can imagine right now when you want your child to have a good education, and then something just happens and you lose your life. But you had a good goal for your child, the child you brought here on earth. You don't know, you're not sure, or you don't know if you leave the child suffering. Will the child continue with education, or with his dreams or her dreams end there? So the best thing is to start saving early. So in a bank, when you, for example, if you had saved like 100,000 in a bank, and by bad luck, or by God's time, you happen to leave, your beneficiary get their money, but you get the money as it is, 100,000 as you had saved. What if you had saved in a circle? Other circles have some sort of insurance whereby if you had saved like 100,000, you can get like 200,000. They most of them multiply by two. So at no time you will lose the money. But in insurance, there's something called sum assured. Sum assured is the pre-forecast amount you want to attain after a certain period of time, so that it will be able to cater for your child or for any goal that you have. So if you had a maybe if you had a sum assured of 1 million, you said after the 10 years I want 1 million, and then by you continue paying your premiums faithfully, at the end of that said term you'll get your money as 10 million, or as the amount you had pre-forecast. Right, are we together? As the amount you had pre-forecast, as long as you're paying your premiums faithfully. So what happens if you die, or if you live and you had a cover with an insurance company? This is what it happens. If you had paid, this is a life cover. It has given you a life cover up to a limit of the sum assured, up to a limit of the amount you are pre-forecasting to pay for this for the fees of your child. Yeah, right. So for this case, you are working with 10 million. So if you are pre-forecasting at 10 million, you have a life cover which is much worth that 10 million. So when death happens to you, or to the principal member, the one who is paying the premium, the policy holder, the company now, as now the insurance company comes in and continues paying your monthly premiums. If you're paying 10,000 per month, the company will continue paying 10,000 per month, and at the end of the term, your beneficiary or the person you had written as the next of kin will get the amount that you had pre-forecast, the 10 million. So that is one advantage of insurance, is that you transfer the risk from yourself to an insurance company, whereby now it will assure you that no matter what happens, as long as you are faithfully paying your premiums, you will get the pre-forecast amount, the 10 million now. So if that happens, the bank will give you the 100, the SAC will give you the 200. But what about insurance? Insurance will give you your sum assured. Even if you had contributed 100,000 against the sum assured of 1 million, of 10 million, you'll get the 10 million at the end or at the maturity. Also, there is something called critical illness. Even if you get a critical illness and you are still paying your premiums, when you get a critical illness, also yeah, that is catered for. So it is good to have all the three, but which one will work best for you? It's upon you now to decide. Are you going to transfer the risks from yourself to an insurance company who are able, you know what normally what the insurance company does is that when you give me your 10,000, the other person 3,000, the other person 5,000, we create a common pool whereby all those money is put in one pot, right? And the probability of us having claims that maybe all our clients have died, it's very minimal, it's 1%. But when you maybe you die and your pre-focus was 10 million, but you didn't have an insurance company, insurance policy, education policy, you're done. And that's it. You leave your child suffering or anything. But when you transfer the risk from yourself, you transfer the risk from yourself to an insurance company who are managing the risks because they have a common pool. Even if you come and claim your money, we continue paying the premiums for you. It will not feel the pinch because you have a common pool whereby many people have brought in their money, and the probability of all those people claiming death is it's 1%. So that's basically how life insurance covers. I can give you more insights as you proceed, and I invite you to continue watching and looking back here because I have more and more and more. I'll also take you through how you can have a whole life cover whereby you can say like I want you to I want to pay a certain amount like 500,000 to your company, and I'll be cautioned like after my death my family will get 5 million. In case of critical illness I'll get 2 million. In case of death also there is that one for Maombolezi Musumari of maybe 150,000. So there's a way you can also plan all that. So we have a lot of products. If you stay tuned, I'll take you through, and I believe here you'll get a lot of knowledge, and I'm willing to take you through. This is Anthony, and thank you for watching, and feel free to ask any questions. Thank you very much, and cheers.